Hello, everybody. Thanks for joining us. My name is Jeff Lucyk. I'm the head of the retail sales team at Horizons ETFs. Wanted to thank everyone for joining. There's a lot of interest in today's webinar, and that's understandable considering we're talking about the search for yield in a very low yielding environment. Just to set the table first, there's a toolbar, a taskbar, probably in the right-hand corner of your device. Within that, there's a couple handouts that are available to you, mainly the covered call brochure in English and in French. So you're able to download that and peruse that at your leisure. Also, you have the ability to ask questions throughout today's session. If you have a question, you can type it in. I'll do my best to get to the questions during or at the end of the presentation. And if we don't get a chance to get back to everybody today, we'll try our best to reach out to you after the webinar. So I always like to set the table on why we're doing these webinars and why now. And I think the title of today's webinar really says it all: the search for yield. And today's topic is the search for yield using covered calls. The search for yield has never been more difficult than now. Fixed income yields are extremely low. So how can we get the income that investors need? I think I've seen some anecdotal evidence that the average age of an advisor's client right now is in the late 60s. So a lot of investors are nearing retirement. So how can they get that income? Right now, the 5-year Government of Canada bond is 50 basis points, or a little less than 50 basis points. A 10-year U.S. Treasury is less than 1%. So how are we going to get that sort of magic 4% yield off of a portfolio that a lot of people are looking for? So yields are low, and then a lot of people think inflation is low, and that might be the case. But in today's world, there's a lot of inflation in things that we need to spend on. I just saw another recent report that our grocery bills are going to go up by 3 to 5% next year. So anyone that's looking for income certainly needs to find this income to continue to live off of and supplement other income. So that's really the gist of today's presentation, talking about covered calls, how you can utilize covered calls to supplement that income and to supplement your fixed income yields. You still need some fixed income. Yields are a little bit lower. Even corporate bonds are like just around 2%. So how are we going to supplement that fixed income yield and get your total income a little bit higher? So with the agenda today, we're going to talk about that income challenge. Where's the yield? How covered calls work and how do they fit in? And then we're going to give you a couple of different ideas within our lineup that you might consider to use to help provide a little bit more income in your portfolios. And today I'm joined by Hans Albrecht. Hans is a co-manager of these covered call ETFs at Horizons ETFs. He co-manages with Nick Picard. He has a lot of experience in option writing and portfolio management in covered call ETFs. He was previously a floor options trader at National Bank Financial. Lots of experience there and education. Graduate of Oxford FinTech and MIT Artificial Intelligence program, and also an MBA from Cornell. So we're happy to have Hans with us. So what I'm going to do now, Hans, I'm going to pass it over to you, and then we'll go back and forth a little bit. And Hans, just for your knowledge, when you need me to flip a slide, let me know and I'll forward that for you. The joys of everyone working remotely. These are some of the things we're dealing with. So Hans, I'll pass it over to you to discuss the income challenge.
Okay. Thanks, Jeff. So you're going to flip the slides for me. Okay.
Yeah.
So thanks very much, and hi everyone. So yeah, we're going to talk a little bit about markets. Jeff gave you a nice little intro there. We'll talk about volatility, in particular volatility of option markets and what options are pricing in. So in other words, the movement, so when we look at option markets, those prices imply a certain amount of movement. And that's an important component to the premiums and the distributions that we generate. And so hopefully in doing so, we can highlight some of the products that can address some pain points and real needs for you. We're all looking at some of the same issues: low rates, low bond yields. I just saw last week US high yield corporates just hit all-time lows. So you look around the world, Portuguese 10 years just went negative. We're talking about Portugal. Pretty amazing. So returns are thin, reach for yield is more alive than ever, especially on a real yield basis. And that's really a key concept here for us with some of the things we're talking about. And it's going to play an important role in the value that covered calls can generate, as we'll sort of uncover here. So next slide, Jeff, please. So here we are with equity markets making new highs. It seems like almost on a daily basis, and we've climbed this incredible wall of worry. And like it or not, there are still a lot of compelling reasons for us to be hopeful in markets, and especially in light of the recent vaccine news. We actually have a balanced one-ticket solution at Horizons that's done really well. It's 70% equities as opposed to the traditional 60%. And so we're actually starting to see more and more written about how essentially 70 might be the new 60, implying that an equity allocation might have to be a little bit more aggressive than we've traditionally thought of it in the past. Slide, please. So I'm not saying that valuations aren't rich. There's no question. We're seeing P's up there. We know the Schiller number is stretched. We've seen some valuations near 20-year highs. Price to sales on the next slide, Jeff. Stocks have done very well given the serious recession that we're in. But as managers and advisors, we have to play the hand we're given. The fact is that we're in recovery mode. As we look past the very serious health issues that are occurring as we speak, but markets seem to be looking past that. And interest rates really, really matter. So I've had a number of interviews this year where they've always asked me, how is it that stock markets just keep going and in spite of all the things happening in the world? Of course, there are other things, and it's a longer conversation about technology bias and big cap strength and all that stuff. But the fact is that rates matter, and they're very, very low. On the next slide, we can see that markets have done well. Covered calls have a unique way of dealing with a long position in equities by finding some of that additional yield while you're maintaining an allocation to equity. So it's a very unique approach to maintaining exposure to a good deal of upside while adding that sort of sleeve of extra income. They have kind of quite a unique positioning within portfolios these days. So Jeff, the next one, as I mentioned that rates matter, so does stimulus, of course. The Fed, the ECB, a lot of central banks are committing to low rates. We even saw Lagarde say that despite vaccines, that's not going to impact their view that more stimulus will be required. So we've also seen this year that the Fed has said it's going to let inflation run above target. That's an entirely new approach. They're not as fearful of inflation following the lessons that they learned in the last decade and after the financial crisis. The Fed just isn't going to get rattled by low unemployment because it simply hasn't shown to have much of an effect on inflation in the last decade. So that leaves us with low rates for longer and negative rates in traditional fixed income. So this is really amounting to this investment picture that looks pretty meek for income seekers. And so I'm not saying that fixed income isn't a place to be, that it's a place to ignore. Capital preservation is very important as well in portfolios and for certain demographics, et cetera. But the backdrop is looking like it could be very favorable for equities for some time to come. So I think that's what these markets are really buying into. Hope the glass is really half full right now. But given that we might see low rates as remaining low for a very long time, the picture may not change as quickly as some people think. Slide, please. So an income approach to ETF investing, a little bit different from what you might know. So upside, so option premiums have this potential to supplement the dividends that you're already getting, maybe even create some yield in names or categories like a gold or natural gas that offer zero dividends to begin with, a really interesting value proposition there. From a tax perspective, option premiums that we're collecting each month are considered capital gains. They're considered by the CRA as a small hedge for those underlying stock holdings. Reduced volatility, we'll talk about that soon. Diversified and convenient way to use options. This is just about the most conservative option strategy you'll find. You own the underlying equities, you sell calls against them. Folks have been using this strategy since the dawn of calls in the 1970s as a way to supplement dividends, generate that additional sleeve of yield. Downside, sure, you can see negative returns. These are not puts. This isn't some sort of insurance policy. There is some downside. You do, at the very core, need to believe in equities as a longer term holding. In the meantime, these premiums, as we'll show you, can sort of add some value when things are sitting around, when things are dropping a little bit. Those premiums are going to add up over time. Slide, please. So this might be an overview of how you could expect covered calls to perform over time. So consider the wider band that includes the blue outcomes, the upper outcome, and the lower outcome as owning equity straight out. So you've got potentially higher upside, you've got potentially lower, a lower downside, more downside. In the middle is what we call covered calls. So we're trading something for something else. So we're trading, we'll see that it's not always the case, but generally speaking, you can say that you're trading some potential income above a certain point for some income now, which I explained is capital gain. So as people buy calls in the markets, there are many reasons to do so. They are expressing a sentiment on where they think a particular stock is going to go. Where is Microsoft going to go? They are buying leverage. We are taking the other side of that trade, selling that call. We don't employ leverage in our funds, but I'm just using that as an example of what a buyer does. They'd like to turn a dollar purchase into $5 perhaps. We don't care about that. We say, look, we're not sure where stocks are going to go over time, but beyond a certain point, we don't think Microsoft's going to go much higher than that. So we can monetize that sentiment that we see in option markets. Over time, what that's going to mean is you're going to see a little bit lower volatility in a covered call fund, a little bit of a smoother ride. Slide, please, Jeff. So I like this slide. It kind of shows you between 50 and 52.5, which is your strike price, where you're going to make and lose money. There's a lot of information on the slide, but essentially, I think what I like to say here is that there's this misconception that covered calls only apply when you expect markets to sit around for a while, sit around for years. That's not true at all, because we sell out of the money calls as we monetize this sentiment by selling calls against our underlying stocks. So our strike prices can be 3, 4, 8%, maybe 12% out of the money, depending on the sector or environment, right? A Canadian bank is going to have a lower volatility. Our strike might only be 4% above where it's trading. On a gold stock, an HEP, it could be 12, 15% above, depending on where the environment is. So, and in addition to that, we rarely sell calls against our entire position. So if you ask your wholesaler for a fact sheet, it's going to show that we typically sell between 25, 50, 60% coverage. And that means that generally speaking, at least half the portfolio in these funds can rise in lockstep with the market without ever being capped. So we are adjusting our coverage as we see fit, as we see the environment give us better option prices, worse option prices. We use a number of other metrics as well. Slide, please. So a good example over time. Well, an okay example, I think. This shows the BXY, which is an at-the-money CBOE index, and it shows, for example, in the financial crisis, where the circle shows that outperformed. The blue periods of where the covered calls in this particular strategy have underperformed. I think our active management is going to generally outperform this kind of thing with over time, and I think that's where active management comes in to make the difference. This is selling at the money calls. This is doing the same thing over and over, month after month. As I said, Nick Picard and I are looking at things differently from an option volatility trader's perspective. Together, we have 50 years of experience, quite literally trading derivatives and options the entire time. And so we have the perspective that I think is required to extract value where we see it's fit. If we are getting low option premiums in financials, we're simply not going to sell them, because we always have to keep in mind that selling away some of your upside is always part of the game. You want to do it when you're getting paid properly. Slide, please, Jeff. So I don't want you to get bogged down with the numbers and the Greeks here and all that fun stuff, but the message here is that relative option pricing is going to deliver better premiums along with higher strikes, because we use a delta, and that's another Greek for you, but we use a delta. Because of that, our strategy evolves with the volatility environment. So if you go from column A to column B, where the VIX has gone from 15 to 25, you are going to notice, if you care to look through here, you're going to notice that you're getting better option pricing and a 75% better strike price. So suddenly you're selling a strike that's quite a bit higher than where the stock is trading. These are two very important factors in a higher vol environment. And that's an important consideration, because right now it's a very unique environment. It coincides with a VIX that has sort of sat between 20 and 30 for a number of months, as stocks have made all-time highs. Or are hovering near highs or recovering towards highs. So a very important point in my mind between for covered calls is that the spread between real yields, so we've seen yields plunge and we've seen real yields plunge, the spread between real yields and what you're getting in markets is quite simply the widest I've seen, and I've been doing this for almost 25 years. So just at a time where we're struggling in particular to find any kind of yield anywhere, you're getting option pricing that is reflecting some uncertainty still. And by no means, for sure, the VIX can drop. It could drop to 15, 14. Still at 13 or 14, you're looking at a wider spread that we've seen in many years. So I think it's just a very interesting environment for the strategy. Slide, please, Jeff. In here, you're going to see that, over the long run, you're basically going to look at, if you look at some of the return metrics on the BXM, which again is the at the money, which isn't as applicable to the out of the money strategy that we mostly employ, although in our commodity funds, or our HGY, which is gold, HNY, which is natural gas, we do apply a lower coverage of at the money calls because we want to retain a good amount of that upside. We'll talk about HGY in a moment. But typically, you can sort of look at these strategies as over a cycle, over longer periods of time, you're going to get fairly good returns. And importantly, you're going to get lower volatility. So if that's important to anyone, the smoothing out of the ride of owning equities over time can be smoothed out with this kind of strategy. Slide, please, Jeff.
Thanks, Hans. That was a really good explanation of how options work, how you're using options to generate some more income on the portfolio, and trying to explain that without getting into too much technical talk. So thank you for explaining that in sort of investor language. So what I wanted to do now is just highlight a couple different opportunities that one might consider. We have a lineup of 8 different covered calls, and I have a slide that shows all 8 in a moment. But I wanted to start with positioning our U.S. equity exposure ETFs. It's the Horizons Enhanced U.S. Equity ETF, and that's the ticker HEA, and then there's also U.S. dollar version HEA.U. This provides broad U.S. exposure, but as Hans has explained, we're writing covered calls on a portion of that exposure to provide some extra tax-efficient yield. And there has been a question that's come in on the tax efficiency, the tax treatment of the yield. And Hans did mention that the option premium itself is taxed as a capital gain. So most of that yield is tax efficient as a capital gain. There could be some income or some dividend in there as well, depending on the underlying and where it's coming from. So some of the key features of HEA and HEA.U, does have a management fee of 65 basis points. You're getting that active management of deciding how much of the portfolio to write the covered calls on, and how far out of the money those covered calls are being written. The yield, this is the important part. So right now, the current yield as at the end of October, so it's over a 6% yield, and again, that's got some tax efficiency to it. The options coverage, we say up to 100% of the portfolio. but it's usually sort of more in that 45 to 60 range on how much of the portfolio is being written on and how far out. And with this portfolio, you're getting an equally weighted basket of 50 underlying equities, and then having that option premium written on top of it. So here's some examples of the names that are in the portfolio. I really want you to note the beauty of this portfolio is you're getting some of those technology names. You see Amazon, Alphabet, which is Google, Facebook, NVIDIA. So these are names that don't traditionally have that much yield. So this is a way that you can own some of these names that don't traditionally have much of a dividend and have that enhanced income supplemented via covered calls. So, and another example of a holding that doesn't traditionally have much yield that a lot of people have been interested in recently is gold. So Hans, I'm just going to pass it over to you to maybe just give us a little bit of your opinion on why gold, maybe why gold now, and then we'll get back into some of the gold covered call ETFs.
Yeah, so thanks, Jeff. So, you know, I mean, gold, I think the narrative has kind of changed on gold throughout the years. You know, in 1 minute it's inflation, the next it's deflation, it's serious amounts of debt. Occasionally it's geopolitical uncertainty, although I found that that's often short-lived. I think what we're really seeing is that, and our funds have really taken in terrific assets this year, because I think people are starting to get on board. You know, gold is in short supply. A lot of the great discoveries have been made. A lot of mines have been shut in the last sort of 5, 6, 7 years as we went through that more difficult period for gold. So, you know, I think what we're seeing is that gold is this asset that reacts to extremes. And so even before COVID, it was in this bull market. Economic growth had been slowing. We were in a bit of a profit recession, believe it or not. But it's been following real rates very, very well. Initially with COVID, we saw worries of deflation due to wage and economic softness. But the story really has more recently turned back to sort of the massive amount of debt out there. You look at some countries, developed market debt has risen around 50% over the past year. I mean, it's quite amazing to see how much money printing there has been. And
yeah,
I
Hans,
think
Hans, did we just hear a stat recently that you know, 23% of all the U.S. dollars created in history have been in 2020? That's an amazing amount of new money supply out there.
Yeah, it's absolutely phenomenal on a level that no one anticipated. And so, you know, I think the theme is that, look, stimulus is crucial to avoid doom and gloom. I think thus far we've seen a lot of stimulus to make sure that people survive, but there will be a lot of rebuilding. There will be many jobs that have been permanently lost. You know, 40 million people are facing eviction in the U.S. I think, you know, there are still some very, very serious problems. Siegel the other day was calling for 3 to 4% inflation over time. So, you know, the inflation argument is really flipping back and forth. Will there be little inflation because of wage softness, because of technology, or will we sort of have this kind of sugar rush of revenge spending in this booming economy? We have, you know, money market accounts just soaring, and deposit accounts, and a world awash in cash, as you're alluding to, Jeff. I mean, this could really go get a little bit crazy at some point if a lot of markets start to open over the next 6 or 7 months. And central banks have committed to low rates for a very long time. I heard about an HSBC rate the other day, under 1% here in Canada. It's a variable rate, I think. I mean, they are really, really stimulating and supporting. Disposable income is up over the last year. So there is money out there ready to go to work. And so it'll be very interesting. We've seen the 10-year break-evens really come back. Expectations for inflation are even surprising David Rosenberg. So, you know, we'll see how that plays out over time. But I think gold is really that play that hedges financial engineering. And even though we've seen a bit of a pullback here, we've seen very few of our investors. We've seen almost no redemptions at all. And so I think they're very interesting levels at this point. Yeah, so we can look at the different scenarios. I mean, number 4, a raising of interest rates. You know, I don't think that's really likely, but you know, that could be difficult for equity markets. We've just created so much debt. It's going to be tough. I don't know what you think, Jeff.
Yeah, I think so, and I think you've discussed sort of the scenario that we're in with we're awash in new money supply, and yet we still have very low to and negative real interest rates, is what which we define by what's the yield minus the inflation. So saving, you're in a negative interest rate environment, a lot of extra new money out there. Good case for gold.
For sure. And so we have a couple of products. Yeah, here you go with the debt.
Yeah, and I think you already discussed this, correct, Hans?
Yeah, I mean, this is something, it's something special that we're seeing out there. And that's really why this hasn't felt like too difficult of a recession, is because, a lot of people haven't been in trouble. They've been supported, and the debt levels have really been juiced because central banks and governments didn't want to take a chance. They just threw everything at the wall, and so we'll see how that plays out. How stimulus kind of is adjusted going forward. But we do have a couple of products that have been very, very popular. One of them is HGY, which you might want to talk about.
Yeah. Thanks, Hans. And I know in the U.S. they're still fighting over the stimulus package, but I'm sure something will come and continue to add to that money supply. So as I mentioned, in the U.S. with our U.S. covered call ETF, you're getting some technology names that might not have a lot of yield, and now you're going to be able to own those and get some income. Some of that needed income from it. This is a unique opportunity where you can own gold, and one of the biggest criticisms of gold over the years has been that it doesn't pay a yield. So this way you can own gold, but write options, and Hans mentioned that this portfolio specifically writes at the money options on a third of the portfolio. So you still can get some upside in the gold appreciation, but you're going to get a nice tax efficient yield off of it as well. Right now, as of October 31st, the current yield on that portfolio was 6.85%, so almost 7% own gold, which you might want for its own reason, and then get a nice tax efficient yield on top of that. For 60 basis points, getting those options written for you on that portfolio. So we like to call it putting gold to work, and this can work in a lot of different ways. A lot of people have the perception that you're going to give up too much upside if you're writing covered calls, and that would be the case if you were writing covered calls at the money on 100% of the portfolio. But as I mentioned, we're only writing at the money on a third of the portfolio. So in theory, you would get 2/3 of the upside, but yet a nice tax efficient yield as well. So a flat gold price, it can work well. Moderate increase, it can work well. Volatile gold price, and the volatility pricing on across the board is still attractive. So yield, real yields are very low, but volatility pricing is high. So it's allowing covered call premium to be generated to even be a little bit higher right now. And even a decrease in gold price, a slight decrease, you'd be able to make that up with the yield generated. The one time where it might not work out, especially if you're a true gold bug, is if there was a sharp increase in gold price, you would miss some of that gold appreciation. So just showing you how HGY has performed in comparison to gold, just pure gold, you would see that it has lagged a little bit, and I've sort of discussed that, how you're giving up a little bit of the upside, and we have had a nice gold appreciation in the last couple of years. So we've given up a little bit of the upside, but the trade-off is that you're getting that tax-efficient yield that you might be using to fund your lifestyle, and you need that income to live off of.
Yeah, that's a good point, Jeff, because oftentimes we don't like to add something that generates no yield. That could be a detractor from buying gold. And so for advisors and investors, if you want to keep that yield up in your overall portfolio for a client, this is a great way to do that, to add a little bit of incremental yield from that call selling and suddenly turn gold into something that looks a little bit more the way you want it to look.
Right. And then the next option is the gold producers, so the actual gold companies that are producing the gold. And this made news a little bit a few months ago because Warren Buffett made an investment in Barrick Gold, and Warren Buffett is known for not being a true believer in gold, and probably because of that, it doesn't generate yield or doesn't generate earnings. But what he saw, the opportunity he saw, is a company that is generating earnings from gold looked really attractive to him, and that's helped investors look at gold a little bit differently, because with costs controlled in the gold right now, and gold at or close to record highs, these gold companies can make a lot of money. So in this scenario, you can own a basket of the gold producers and have options written on those producers to create extra yield, because a lot of gold companies don't pay that much in dividends either, even though some are now starting to do so. So you can own gold producers and get a little extra yield. Similar, 65 basis points for owning these gold companies and getting those options written for you to provide that income. Another equal weighted portfolio. So you're going to have a basket of gold producers, and we'll be writing covered calls on a fraction of that, of those holdings. So here are some of the holdings that are in that portfolio. Barrick is in there, of course, and a lot of other ones you might recognize.
Yeah, it's got, you're going to recognize many of those names. Some of the big producers, some of the streamers are in there, which have been quite popular at times, and some of the silver producers. So for the silver bugs out there, if we're looking at an economic recovery around the world, of course, gold has not a lot of industrial purposes. Silver very much so. So, we do have good exposure on the silver side as well.
Good. And Hans, maybe you could just quickly go over the gold miner fundamentals. I sort of talked about that a little bit, if you wanted to add something to that.
Yeah, I mean, I think people often ask us, well, which one should I go with? The gold, HGY, HEP? Should I go with gold? Gold is pure play. It's kind of, some people just want to own the actual yellow metal, and they're happy with that. We have seen quite a bit more interest, probably 3 to 4 times more interest in the miners. I think people in part like the extra beta that they get out of that. The miners tend to move sort of 3+ times to the price of gold.
And they had lagged for a while. I think people had saw that opportunity as well.
Exactly. There's a belief that there could be some catch up to play. If you look at a long-term miners chart, if you look at XGD or GDX, you can see that there's certainly some room. If you're a believer in gold, there's some room for the miners, and they've really cleaned up their balance sheets. As I mentioned earlier, there was a difficult period where mines were closed. They got a little bit exuberant on the acquisition side. In the 2000s, they were hedging a ton of their production. These things look very different today. These are good, much better looking companies. And I think that's what Buffett is looking at. He's saying, Barrick at 11 times forward earnings, he's saying, markets are pretty rich here. Wait a minute, what about this gold complex? These companies can do well. So if you own HGY, you basically you're on board to ride the actual price of gold. With HEP, you're owning a basket of miners that can execute well, maybe not execute as well. We don't know how they'll do over time, but they're in position to do well, and they're going to be able to do quite well with gold above 1,400, 1,500. So there's sort of a wider range of, if gold goes to 1,700, these companies are still going to do quite well. If it goes to 2,000, they're going to do very, very well. So you kind of have a little bit more of a range of scenarios where you can potentially do well from an executional standpoint on the side of the miner. So yeah, I mean, a lot of good things have developed over the last 4 or 5 years. As I mentioned, some of the very big mines have been found. Some of the big supply has been found. And it's looking like supply is just going to dwindle over time. So look, they're not printing any more gold, right? I like to say they don't print any more gold, as they can print money. So it's a
contrast to all the money that we just discussed has been printed just in this last year. Right. Excellent.
Exactly.
Good point.
And also, Jeff, I wanted to mention, so from an HEP standpoint, if you look at XGD, you've got about, I think last I checked, it was around 12 basis points of dividend income. That's really, really meager. And so HEP really turns that around and turns a basket of gold miners, silver miners, producers, streamers into a basket of something that can actually yield something meaningful.
Right. And thanks. I may have forgot to mention the ticker on that HEP for the Horizons Enhanced Gold Producers ETF, and that it yields as of October 6.23%. Again, that tax-efficient yield. And the performance against a basket of producers without covered calls on it, you'd see in some circumstances that it lags again a little bit because we've had a nice run even in the gold producers, but the trade-off again being that tax-efficient yield that you're receiving from it. But there are periods where there's been even outperformance in that 6-month period. This portfolio has outperformed sort of the global basket of gold producers, and that could be based on just the equal weight and maybe more concentrated underlying holdings. But you're going to get a basket of gold and silver producers like Hans mentioned and get that tax-efficient yield generated from writing covered calls on that portfolio. This is an interesting slide. I wanted to just show the historical calendar yield that each of these ETFs have provided going back to 2011 on HGY, the gold yield, and 2012 on the gold producers. It's provided a nice, consistent, tax-efficient yield along the way. I think the lowest in any year on either of those products is 4.2%, and you've had some big years in nice tax-efficient yield as well. But we've sort of seen anywhere sort of in that 5 to 7% in the last little while. So again, owning gold that might not traditionally pay much yield and getting that a nice 5 to 6% tax-efficient yield on top of that. I mentioned the complete basket of the Horizons covered call ETF lineup. I mentioned we have 8. We have 3 based on geographical exposure: Canada, U.S. that I talked about earlier, and international. And international is getting a lot of international investments are getting some renewed interest, probably more on valuations, and emerging markets and weakening of the U.S. dollar. So this is a way you could even invest in international equities and have some covered calls written for you. Then there's 3 on underlying Canadian sectors, the gold producers we talked about, but there's also energy producers, and there's also the financials, which includes the banks and the insurance companies and some asset managers. So if you're liking the financials, this is a way you can own some financials and generate some extra yield as well. And then the 2 commodity ones, we talked about HGY, which is the gold, and there's actually one on natural gas as well. And you can see the estimated, the 12-month trailing yield in the middle there. The lowest was in the last year has been 5.26%, and as high as 7.6% in that tax-efficient yield. So Hans, if you just wanted to summarize some important considerations for covered calls.
Yeah, so I mean, in summary, I guess a great way to stay long equities, right? So if you look at this, on the spectrum of, full fixed income, full equity, this kind of dials back your speedometer a little bit to, add that sleeve of income from option markets that are expressing a certain sentiment that we can monetize on a monthly basis. We tend to sell 1-month options. Occasionally we'll use weeklies if we're trying to work around an event. We don't like to be too aggressive around earnings, around big events. So nice to have that kind of flexibility in option markets. These are all listed options that trade in the US and Canada. We are not trading any over-the-counter options whatsoever. This is all listed stuff. And so, that whole idea of getting paid for volatility, getting paid to wait. Sometimes we don't know when that next leg up is going to be. But right now, I'm really impressed with this sort of unique proposition that, equities are trading near all-time highs, yet there's still this uncertainty. We don't know what the reason is. You can take your pick. We're still trying to claw our way out of this pandemic situation. It could be, worries about GDP growth, about permanent job losses, unemployment may not settle down at low levels. Robin Hooders driving up call pricing, that's been a part of it as well, quite possibly, of pushing up call prices, which we welcome. Maybe it's something more insidious, like some of these quiet defaults we've seen in China. But, as much as equity markets are rallying, all is not perfect in the world. And so as long as we see these option levels up here at more, at quite elevated levels, that's going to really work well for us in terms of the premiums that we're bringing in and the strike prices.
Right, and you mentioned
important to, yeah.
So those volatility levels are you're seeing them are a little higher than normal, so you're actually able to generate a little bit extra income using those.
Exactly, and that's something we can't predict. Volatility levels drop and they rise, but it's quite interesting in here that we don't typically sit above 20, 22, 23. That is usually symptomatic of a problem, underlying problem in markets as markets are selling off. So very unique thing that I haven't seen in probably 20 years, I would say. There were periods in the dot-com bubble where you might have seen that. So it's all a good recipe for covered calls.
And yeah, and that's, I might circle back to sort of how I introed on and the search for yield. So, you know, these are providing that, you know, I think people want to know how to use these, and I think it's in conjunction with some fixed income, and maybe that fixed income weighting is a little lower, depending on your circumstances, but you still have your equity exposure that you might have, but by using this, you're getting that same equity exposure, but you're generating some extra income on it. So when you combine that with the fixed income yield, you might have you'll have a higher blended yield off of your portfolio. So I can just get into some questions, and after that summary, well, one was, is there going to be a replay of this webinar? And the answer is yes. Anyone who registered for this webinar will receive a replay in a couple days, so you can expect to see that in your email boxes. And we also got the question on the returns that were shown. Was that the price return only? And no, all the returns shown are total return, price return, and factoring in the yield provided as well. So Hans, maybe some more technical questions for you that one of our listeners had. In a rising market, what strategy do you employ to ensure that the underlying is not called, but we know it can be, or if it is called, do you buy it back at a higher price?
Yes, so we try to avoid that as much as we can. So if around expiry, if the calls are in the money, we will roll them into the following month or the next month beyond that. We don't like to crystallize gains if we don't have to, that there are tax implications for our unit holders, so we're always managing that risk. The only other time you're going to get called away is, you know, ahead of ex-dividend date, and we manage that, mitigate that risk as well. So we will usually roll. Very occasionally someone will exercise calls early and we buy back the stock. We'd like to stay fully invested. Good question.
And then another question was on the tax considerations, and how is it taxed? I think we addressed that it's the option premiums are capital gains, but the underlyings might be providing dividends, or in the case of international equities, it would be in the form of income. Is there any other thing in return of capital, Hans? Are you aware of that?
Yeah, you're going to see a breakdown at the end of the year of any dividend income. So importantly, any dividend income that you would normally get from those holdings, you still get that. So you see different tax treatments depending on what you end up with at the end of the year.
Right. So it'd be a combination of, could be a combination, all of them. Definitely some tax efficient distribution in there in the form of capital gains from the option premium, which would be a good chunk of that. And at the end of the year, we provide that breakdown on our website as well as on tax slips. We had a question on what percentage of ATPs the gold producers holdings have calls written on them right now, Hans?
Well, we can't get into too much detail that isn't public, but we have tended to keep it at the lower end of the range between 25 and 35 to 40 in the last year. The reason for that is covered calls on the gold complex, whether it's gold or miners, is I like to call it a little bit of a perfect storm for covered calls, because as the underlying assets rise, you see option prices actually rise, which is usually the opposite in the broader market. You see the VIX come down. And so we're starting to get, we don't have to get as aggressive, first of all, because the premiums are better, because gold is in play and miners are in play. Secondly, because we tend to keep the coverage a little bit lower anyway in those funds, because we know that if we walk in one day and gold's up $400 or $500, does a Bitcoin on us, and we want to make sure that we have retained most of that upside.
Good reference to Bitcoin. Digital gold
is the original Bitcoin, by the way.
That's right. Yeah. Is Bitcoin the new gold, or is gold the original Bitcoin? Chicken or egg, but I think both have that same sort of belief in that that store of value. Just a quick yes, the replay will have the video as well as audio, so you'll be able to pause that when you're reviewing that on your own. And just the last question, and I think this is an important question: how do we determine how much your payout each month is to your unit holders? And that's a great question, because we actually analyze this on a fairly frequent basis. So we don't say this will pay out 7% and then keep it at that 7%. And the reason for that is then that will end up in some months having that return of capital and the grind of your net asset value. Where in our analysis of this, we're trying to pay out the yield that's actually generated. And we might smooth it a little bit here and there, but that's why every month we put out a piece that shows, and it's on our website, the 12-month, the trailing yield and the expected yield based on what the payout is for that month on that net asset value. So we try to pay out what is being generated rather than a set distribution, and then risk not being able to generate that and paying that out of net asset value. Hans, did you have anything to add to that?
No, that's exactly it. You'll see them. You'll see the payouts as fairly consistent over time. They do fluctuate a little bit depending on premiums that we're bringing in. Was there a dividend in there, and the broader environment as well.
Okay, good. So yeah, we try to smooth it and keep it consistent. It's just we don't have a set distribution. That'd be the best way to summarize.
Correct.
And as I mentioned, that all that information is on our website. So if you go to the web page of any of our covered calls, there's a tab on the lower right-hand corner that says distributions, and you can click on that and see what the expected yield will be for that month. And I'll finish on this. I mean, we're social, so please do contact us. Our 1-866 number. You can email us at info@horizonsetfs.com. We're on Facebook, Twitter, Instagram, LinkedIn as well. So please engage with us on the platform of your choosing. And we're going to end there. So Hans, I think you did a great job explaining why covered calls, how you are generating extra income with covered calls. And then we reviewed a couple different opportunities in more detail, being the U.S. And our gold opportunities, gold bullion, and the gold producers. But I'm glad I had a chance to highlight some of the other ones, as the financials are getting some attention now. People are looking at the banks and the insurance companies again, and the international offering, as well as people might be trying to diversify a little out of the U.S. after such a big run-up. So thank you for your time, Hans. I want to thank everyone's attendance. It was a very well-attended webinar with a lot of interest, and as I said, with yields so low right now, I figured that would be the case. So hopefully everyone got some ideas on using some covered call ETFs to supplement that yield if you're looking for a little bit higher yield in your portfolios. So with that, we'll end today in good time.
Jeff.
Thanks, Hans. I really appreciate it. Thanks again, everybody. I look forward to the next one.
Thanks, everyone.